Welcome to Samba Samba. Enjoy the video.
In this video, I will explain how to fill out a Schedule D. First, understand that Schedule D is used to report capital gains and losses from the sale or exchange of capital assets, like stocks or bonds. This form helps you calculate your net gain or loss, which then impacts your overall tax liability. You'll typically need information from Form 1099-B, provided by your brokerage, to accurately complete this schedule. It's crucial to have all your transaction details ready before you begin. Next, distinguish between short-term and long-term capital gains and losses. Short-term assets are those you held for 1 year or less, while long-term assets were held for more than 1 year. This distinction is vital because the Internal Revenue Service taxes these two categories at different rates. Generally, long-term capital gains receive more favorable tax treatment, so correctly classifying your assets is very important for minimizing your tax burden. When reporting your transactions, you'll list each sale or exchange in the appropriate section of Schedule D. Part 1 is for short-term transactions, and Part 2 is for long-term. For each entry, you must include the date you acquired the asset, the date you sold it, and the sale proceeds. Then, subtract your cost basis from the proceeds to determine your capital gain or loss for that specific transaction. Accuracy here prevents issues. Finally, sum up all your gains and losses within both the short-term and long-term sections. Then, combine these totals to arrive at your overall net capital gain or loss. This final figure is then transferred to your Form 1040. Remember, if you have a net capital loss, you can deduct up to $3,000 against other income. Check the description for a link to these fantastic leak-proof containers and other great deals to help you stay organized.
Thanks for watching. Consider subscribing if we helped you.